The first system to break in the 2026 crash is obvious: credit markets. Corporate bonds freeze, leveraged loans seize, commercial paper stops rolling, banks tighten lending. This is the initial crisis, the trigger everyone sees. The headlines scream about credit crunches and frozen markets, but credit markets breaking is just the beginning. While policymakers scramble to address the credit crisis, while the Fed creates emergency lending facilities, while Congress debates bailout packages, a second system is breaking. Quietly in the background, less visible but potentially more catastrophic. The second system to break is the collateral system, the vast network of pledged assets that underpins modern finance. The trillions in securities used as collateral for borrowing, for derivatives, for repo transactions, for margin accounts. When the system breaks, it doesn't just freeze credit, it freezes everything. Understanding why the collateral system breaks requires understanding how it works, why it's already strained, and how the credit crisis triggers a collateral crisis that makes the initial shock exponentially worse. Let me show you exactly how the collateral system operates, where the stress points are, why the 2026 credit shock breaks it, and what happens when the financial system loses confidence in collateral itself. Modern finance runs on collateral. When you want to borrow money, you pledge assets. The lender holds your collateral. If you default, they seize it. Simple concept. But the system has evolved into something far more complex and fragile. Start with repo markets. The repurchase agreement market is where financial institutions borrow short-term, often overnight, using securities as collateral. A bank has $10 billion in Treasury bonds. It repos them out, borrowing perhaps $9.8 billion cash overnight. The next day, it repays the cash plus interest and gets the bonds back. The repo market is enormous. Daily volume exceeds $4 trillion in the US alone. Banks, hedge funds, money market funds all participate. It's the plumbing of modern finance. When repo markets function smoothly, liquidity flows. When they break, the entire system freezes. The same piece of collateral gets reused multiple times. This is called rehypothecation. A hedge fund posts Treasury bonds as collateral to its prime broker. The prime broker then uses those same bonds as collateral for its own borrowing. That lender might use them again. One bond, 3 or 4 uses. Rehypothecation creates efficiency. It allows more borrowing with less collateral. But it also creates interconnection. If one party in the chain fails, everyone downstream has a problem. The collateral they thought they had isn't really there. Derivatives markets depend on collateral. When two parties enter a derivative contract, they post initial margin and variation margin. As the contract value changes, margin payments flow back and forth. Clearinghouses stand in the middle, holding collateral from both sides. The total value of outstanding derivatives exceeds $600 trillion notional. Obviously, not all of this is at risk. Most derivatives net out. But the collateral required to support these positions is substantial. Estimates suggest $507 trillion in margin and collateral posted globally. Prime brokerage operates on collateral. Hedge funds maintain accounts at prime brokers, posting securities as collateral. The prime broker provides leverage, lends money against the collateral. If the hedge fund's positions lose money, the collateral value falls. The prime broker demands more collateral or forces position liquidation. Securities lending is another collateral-dependent market. Pension funds and asset managers lend securities to short sellers. The short seller posts cash or other securities as collateral. If the borrowed security rises in value, the short seller must post additional collateral. This market involves trillions in securities being lent and borrowed constantly. The critical insight is that the entire system depends on reliable collateral valuation. Everyone assumes that Treasury bonds are worth par, that high-RA corporate bonds are worth close to par, that high-quality collateral can be liquidated quickly at predictable prices. When these assumptions break, the system breaks. Even before the 2026 credit crisis begins, the collateral system is already under strain. 3 factors have created significant stress: quantitative tightening, Treasury issuance, and market concentration. Quantitative tightening, QT, means the Federal Reserve is shrinking its balance sheet. They're selling Treasury bonds and mortgage-backed securities back into the market. From a peak above $9 trillion, they've reduced to around $7 trillion. That's $2 trillion in securities returning to private markets. These securities were removed from circulation during QE. They sat on the Fed's balance sheet. Now they're back in the market. But the people who originally sold them to the Fed don't necessarily want to buy them back. The securities get absorbed, but not easily. The result is reduced collateral availability. Banks and dealers hold fewer high-quality securities. The securities that exist are more expensive, meaning yields are lower. This makes repo borrowing more expensive. It reduces the efficiency of the collateral system. Simultaneously, Treasury issuance has exploded. The federal government is running $1.5 to $2 trillion deficits annually. All of this gets financed by issuing Treasury securities. New supply floods the market. Dealers must intermediate this issuance, buying from Treasury and selling to end investors. But dealers' balance sheet capacity is limited by regulation. Post-2008 rules restrict dealer leverage and inventory holdings. They can't warehouse unlimited amounts of Treasuries. When Treasury issuance exceeds dealer capacity, repo rates spike. We saw this in September 2019 when repo rates briefly hit 10%. Market concentration adds another vulnerability. A handful of dealers dominate repo markets and Treasury trading. JP Morgan, Goldman Sachs, Bank of America, Citi, a few others. If one major dealer faces stress and reduces activity, the entire market feels it. Money market fund reform also changed collateral dynamics. After 2016 reforms, prime money market funds can impose redemption gates and fees during stress. This makes them less attractive. Assets shifted to Treasury-only money market funds. These funds invest exclusively in repo markets using Treasury collateral. The shift created massive demand for Treasury repo. Too much cash chasing, too little collateral. This drives repo rates negative at times, meaning lenders pay borrowers to take cash. Distorted pricing signals, inefficient allocation, system stress. Central clearing of derivatives moved margin requirements from bilateral negotiations to centralized clearinghouses. This created transparency and reduced counterparty risk. But it also concentrated collateral requirements at a few clearinghouses. CME, LCH, IC. These clearinghouses now hold trillions in collateral. If something goes wrong at a clearinghouse, the consequences are systemic. And clearinghouses operate on margin models that assume certain volatility levels. When volatility spikes beyond model assumptions, margin requirements surge. We saw this in March 2020 when Treasury volatility exploded. The pre-existing strain means the collateral system is operating near capacity. Dealers are constrained, collateral is expensive. Clearinghouses are concentrated, the system works during calm periods. But it has little buffer for absorbing shock. When the credit crisis begins in early 2026, the initial impact is on credit markets. Corporate bonds fall, leveraged loans trade at distressed levels, high yield spreads blow out. This is the visible crisis. But simultaneously, collateral values are being destroyed. A hedge fund holds $5 billion in corporate bonds as collateral at its prime broker. These bonds were valued at par. The credit crisis hits. Bond prices fall 30-40%. Suddenly, the collateral is worth $3 to $3.5 billion, not $5 billion. The prime broker makes a margin call. The hedge fund must post an additional $1.5 or $2 billion in collateral or reduce positions. But the hedge fund doesn't have additional collateral. It must sell positions. Forced selling drives prices lower. More margin calls. The liquidation spiral begins. This dynamic plays out across thousands of institutions simultaneously. Collateral values falling, margin calls surging, forced selling, lower prices. More margin calls. The feedback loop is vicious. Repo markets face immediate stress. A bank that was repoing corporate bonds at 95% of value, lending $950 against $1,000 in bonds, suddenly faces a haircut increase. The lender now demands collateral worth $200 to lend $950. The borrower must post additional collateral or accept less cash. Reduced repo capacity means less liquidity. Banks can't fund their positions as easily. They must shrink balance sheets. Less market making, less liquidity. Wider bid-ask spreads, markets become less functional. Rehypothecation chains break. Remember, the same collateral gets reused multiple times. But when collateral values fall, each party in the chain faces losses. The hedge fund's collateral fell 30%. The prime broker who rehypothecated it now has insufficient collateral for its own borrowing. That lender faces a shortfall. The chain breaks. Breaking rehypothecation chains forces deleveraging throughout the system. Positions must be unwound. Borrowing must be reduced. This happens abruptly, not gradually. The system goes from maximum leverage to forced deleveraging in days. Derivatives margin calls explode. Clearinghouses use models to set margin requirements. These models assume normal volatility. But volatility in early 2026 is anything but normal. Credit spreads are moving 50, 100 basis points daily. Equity indices are falling 3 to 5% daily. Volatility measures are spiking. Clearinghouse models respond by increasing margin requirements. Initial margin rises 50, 100%. Variation margin payments surge as contract values swing wildly. Members must post billions in additional collateral to clearinghouses. Immediately, some members don't have the collateral. They must liquidate positions to meet margin calls. But liquidating during a crisis realizes losses and creates more volatility, which triggers more margin increases. The doom loop engages. The Treasury market, supposedly the safest and most liquid market, faces collateral stress. Hedge funds run basis trades, exploiting small price differences between Treasury bonds and Treasury futures. These trades use massive leverage, often 50 to 1 or higher. When volatility spikes, margin requirements on Treasury futures increase. A hedge fund with $1 billion in capital and $50 billion in Treasury positions faces margin calls in the billions. They must sell Treasuries, but in a stressed market, selling Treasuries drives prices down. Lower prices mean more margin calls. March 2020 saw this dynamic nearly break the Treasury market. Only massive Fed intervention, buying $1.6 trillion in Treasuries in weeks, stabilized the situation. In 2026, the Fed faces constraints. Inflation is still elevated. Political pressure is intense. They can't intervene as quickly or as massively. The collateral crisis reaches a breaking point when market participants begin questioning collateral quality itself. Not just the price of collateral, but whether certain assets should be acceptable as collateral at all. It starts with corporate bonds. Investment-grade corporate bonds have been standard collateral for decades. But as defaults surge and credit spreads blow out, lenders become uncomfortable. Is a BBB-rated corporate bond really good collateral when the company might default next month? Lenders start rejecting corporate bonds as collateral. Or they demand extreme haircuts, accepting only 50-60 cents on the dollar. This makes corporate bonds nearly useless as collateral. Institutions holding billions in corporate bonds suddenly find their collateral base has collapsed. Asset-backed securities face similar rejection. CLO tranches, mortgage-backed securities, auto loan ABS, these were acceptable collateral before the crisis. But as underlying loan performance deteriorates, these securities become suspect. Lenders stop accepting them or demand haircuts so large they're economically useless. The collateral base of the financial system suddenly shrinks. Only the highest quality assets remain acceptable. Treasury securities and a few agency MBS. Everything else is either rejected or haircut severely. This forces massive deleveraging. Estimates suggest the financial system has roughly $30-35 trillion in total collateral posted across all markets. If $10 trillion of that collateral becomes unacceptable or requires 50% higher haircuts, the entire system must deleverage by trillions. There's no way to do this smoothly. Clearinghouses face a nightmare scenario. They hold collateral from thousands of members across hundreds of thousands of positions. If they stop accepting certain collateral, members must replace it with acceptable collateral. But acceptable collateral is scarce and expensive. Some clearinghouse members can't meet the new collateral requirements. They default to the clearinghouse. The clearinghouse must liquidate the defaulting members' positions and use their collateral to cover losses. But if collateral quality is questionable, losses might exceed collateral value. A clearinghouse facing losses beyond a member's collateral must access its default waterfall. Other members' collateral, clearinghouse capital, potentially assessments on surviving members. If losses exceed the waterfall, the clearinghouse itself could fail. This is a systemic event. LCH, which clears massive volumes of interest rate swaps, holds over $1 trillion in collateral. CME, which clears Treasury futures and countless other contracts, holds similar amounts. If either faces a major default, the consequences are unthinkable. Securities lending breaks down. The short sellers who borrowed securities must maintain collateral with the lender. If collateral quality is questioned, lenders demand more or higher quality collateral. Short sellers can't comply. They must close positions, buying back borrowed securities. Mass short covering during a crash creates violent price moves. Heavily shorted stocks can spike 50-100% even as the broader market collapses. This volatility makes collateral management even more difficult. Nothing trades at predictable prices. When the collateral system breaks, liquidity throughout the financial system evaporates. This isn't just reduced liquidity. This is markets ceasing to function. Market makers step back. Dealers who normally provide two-sided markets, buying and selling continuously, withdraw. They can't warehouse positions because they can't fund them. Repo capacity is constrained. Collateral is questionable. They reduce activity to bare minimums. Bid-ask spreads widen dramatically. Treasury bonds normally trade with spreads of 1 to 2 basis points. During the collateral crisis, spreads widened to 10 to 20 basis points. Corporate bonds trade with spreads of 2 to 5% to face value. For distressed bonds, spreads reach 10 to 20% if there are any bids at all. Trading volumes collapse. When bid-ask spreads are wide and liquidity is poor, buyers and sellers retreat. Why sell at a massive discount? Better to hold and hope for recovery. But this makes markets even less liquid. The spiral intensifies. Price discovery fails. When trading is sparse and spreads are wide, determining fair value becomes impossible. Is a bond worth 70 cents or 50 cents? Nobody knows because nobody's trading. Marks become arbitrary. Financial statements become meaningless. Asset managers face redemptions but can't liquidate holdings. A bond fund receives $1 billion in redemption requests. To meet redemptions, they must sell bonds. But the market is illiquid. They can't sell $1 billion without driving prices down 20-30%. Selling creates losses for remaining investors. Funds implement gates, suspending redemptions. This is legal under extreme circumstances. But it traps investors. They can't access their money. Panic intensifies. More investors try to redeem before gates go up. The run accelerates. ETFs trade at extreme discounts to net asset value. A corporate bond ETF with a NAV of $100 might trade at $80. The 20% discount reflects illiquidity of underlying bonds and uncertainty about marks. Arbitrage mechanisms that normally keep ETF prices close to NAV break down. Pension funds and insurance companies face asset-liability mismatches. They have obligations, pension payments, and insurance claims that must be paid. But their assets are illiquid. They can't sell without massive losses, yet they need cash. The only option is selling the most liquid assets, Treasury bonds, and high-quality stocks. This forced selling of high-quality assets drives down even safe haven prices. Treasury yields rise, even as the economy collapses into recession. This is the opposite of normal flight-to-safety dynamics. It signals complete market dysfunction. The collateral crisis creates multiple feedback loops that make everything worse. Each loop reinforces others. The system spirals out of control. Loop 1. Collateral loss triggers margin calls. Margin calls force selling. Selling reduces collateral value. Lower collateral triggers more margin calls. This loop can't be broken without outside intervention. Loop 2. Reduced liquidity increases volatility. Higher volatility increases margin requirements. Higher margin requirements force deleveraging. Deleveraging reduces liquidity. The cycle repeats at increasing amplitude. Loop 3. Price declines reduce net worth. Lower net worth triggers rating downgrades. Downgrades increase collateral haircuts and margin requirements. Higher requirements force more selling. Prices decline further. The death spiral. Loop 4. Market dysfunction reduces confidence. Reduced confidence causes withdrawals and redemptions. Redemptions force asset sales into illiquid markets. Sales drive prices down. Lower prices destroy more confidence. Terminal decline. These loops operate simultaneously. You can't fix one without addressing all. And addressing all requires resources and coordination that may not exist. The speed of modern finance accelerates everything. In 1929, bank runs took days. People lined up outside branches. In 2026, runs happen in hours via mobile apps. Margin calls are automated. Algorithmic trading executes in microseconds. The loops iterate at electronic speed. Human decision-making can't keep pace. By the time executives convene emergency meetings, the situation has already deteriorated. By the time they decide on a response, conditions have changed again. The system moves faster than human response time. Addressing the collateral crisis requires policy intervention. But the tools available are limited and the constraints are severe. The Federal Reserve can provide emergency repo facilities, as they did in 2019 and 2020. They can lend against wider ranges of collateral, they can reduce haircuts, but this puts Fed balance sheet at risk. If collateral quality is genuinely impaired, the Fed could face losses. The Fed is not supposed to take credit risk. That's fiscal policy, not monetary policy. But in a collateral crisis, the distinction blurs. Accepting impaired collateral means taking credit risk. This requires congressional authorization, or at least political cover. Congress in 2026 is gridlocked. Authorizing Fed credit risk is politically toxic. It's bailouts by another name. The public sees through it. Opposition is fierce. Getting legislation passed could take weeks or months. The system doesn't have weeks. The Fed might act anyway, invoking emergency powers under Section 13(3) of the Federal Reserve Act. They could create facilities to accept corporate bonds, CLOs, and other collateral. But this invites political backlash and potentially legal challenges. Moreover, if the Fed accepts impaired collateral at inflated values, it's essentially subsidizing losses. This creates moral hazard. It rewards the institutions that took excessive risk. It punishes taxpayers who didn't. The political economy is terrible. The alternative is allowing the collateral crisis to run its course. Let institutions fail, let markets clear. This is the liquidationist approach. It eventually works, but at enormous cost. Unemployment reaches depression levels, output collapses. Social fabric tears. International coordination is essential but difficult. The collateral crisis isn't confined to the US. European banks face similar problems. Japanese institutions are exposed. Chinese banks have dollar funding needs. All require coordinated liquidity support. But geopolitical tensions make coordination difficult. Can the Fed provide unlimited dollar swaps to China when relations are adversarial? Can European Central Bank provide euro liquidity to Russian banks under sanctions? The politics override the economics. The Bank for International Settlements could coordinate, as it has historically. But BS authority is limited. National central banks must agree. Building consensus takes time. The markets move faster than international diplomacy. Ultimately, the collateral crisis is a crisis of confidence. Modern finance runs on trust. Trust that collateral is worth what it's marked at. Trust that counterparties will meet obligations. Trust that markets will remain liquid. When that trust breaks, the system breaks. The breaking of confidence is binary. Markets function, then suddenly they don't. There's no gradual transition. It's a phase change, water to ice, liquid to solid, functional to frozen. Signs of breaking confidence appear in subtle ways initially. Bid-ask spreads widen slightly. Repo haircuts increase incrementally. Margin calls become more frequent. Institutions become more cautious. These are warnings. Then something triggers the break. A major institution defaults. A clearinghouse faces stress. A collateral type is rejected entirely. The subtle warnings become obvious crisis. Confidence evaporates. Once confidence breaks, restoring it is extraordinarily difficult. Announcements don't work. The Fed says collateral is safe. Nobody believes them. The government guarantees markets. Investors remain skeptical. Trust, once lost, isn't easily regained. Rebuilding confidence requires demonstrating stability. Markets must function for days or weeks without incident. Collateral must prove durable. Institutions must meet obligations. Only time and performance restore trust. But time is the resource in shortest supply during crisis. The 2008 crisis took months to stabilize even with aggressive intervention. The collateral system remained stressed well into 2009. Full confidence didn't return until 2010-2011. And that was with unlimited Fed support and massive fiscal stimulus. In 2026, with constrained policy response and deeper structural problems, restoring confidence could take years. During that time, the collateral system remains broken. Markets remain dysfunctional, economic activity remains depressed. The cost is staggering. The credit crisis is painful. Companies default, jobs are lost. Portfolios decline, but economies recover from credit crises. Bad debts get written off. New credit gets extended, growth resumes. History shows this pattern repeatedly. But collateral system breaks are different. They threaten the foundation of modern finance, the ability to borrow against assets, the ability to hedge risks, the ability to create liquid markets. When these capabilities disappear, the financial system regresses decades. A world without functional collateral markets is a world of severely constrained credit. Banks can't lend without collateral. Businesses can't hedge without derivatives. Investors can't leverage without repo. The efficiency of modern finance disappears. The economic cost is permanent output loss. Not just a recession that recovers, but permanently lower GDP because the financial system can't allocate capital efficiently. Studies suggest major financial crises reduce long-run GDP by 5 to 10%. Collateral system failure could double that impact. The social and political consequences extend beyond economics. When markets don't function, people lose faith in the system. Populism rises, extremism grows. Democratic institutions weaken. The Great Depression didn't just cause economic collapse. It enabled fascism and World War. Understanding that the collateral system is the second system to break, and potentially more important than the first, changes how you think about the 2026 crisis. The credit freeze gets headlines. The collateral crisis determines whether we face a recession or something far worse. The warning signs are already visible. Collateral scarcity, repo market stress, clearinghouse concentration, rehypothecation complexity. Each of these is a vulnerability waiting to be exploited by crisis. When the credit shock hits, these vulnerabilities ensure the damage spreads far beyond credit markets. This is the second system to break. Not as visible as frozen credit markets, not as immediately obvious as corporate defaults, but ultimately more consequential. Because when collateral fails, everything fails, and repairing a broken collateral system is far harder than fixing a credit crisis. The 2026 crash begins with credit, but it becomes catastrophic when collateral breaks. Understanding this sequence is essential to understanding why this crisis will be different, why the response will be harder, why the recovery will be slower, and why assuming this will be like previous crises is the most dangerous assumption you can make.